First, welcome to Accounting 101. Second, the 4 pillars of standards. Third, crushing creative accounting. Fourth, the standard setting factory. And finally, the current standards landscape. You know, accounting isn't magic, and it's certainly not guesswork. It's actually a highly engineered machine driven by really precise gears, and those gears are called accounting standards. Without them, the financial machinery of any business would just grind to an absolute halt, or worse, spin completely out of control. To really understand this machine, we've got to start by defining our core terminology. GAAP, or Generally Accepted Accounting Principles. Think of GAAP as the ultimate rulebook. It's basically a combination of authoritative standards set by policy boards and the commonly accepted ways of recording information. Its main job? Keeping global and domestic financial chaos at bay. By forcing entities to follow this common set of procedures, GAAP ensures that when a company reports $1 million in profit, we are all speaking the exact same language about what that $1 million actually means. Moving right along, let's get into Section 1, the 4 pillars of standards. So while GAAP is the broad concept, accounting standards are the strict, written policy documents that actually enforce it. And the crucial point here is that these standards deal directly with 4 exact pillars. You might want to take notes here because this is the absolute foundation of our masterclass. First, recognition. When do we officially acknowledge that a transaction happened? Second, measurement. How much is that transaction actually worth? Third, presentation. How do we structure this on the financial statements so it makes sense? And finally, disclosure. What extra context do we need to provide so investors can make truly informed decisions? These 4 pillars are what make financial statements transparent and useful.
Now, standardizing all of this naturally eliminates a lot of confusing alternative accounting treatments. But here's a really vital lesson. It is not enough for a company to just say, hey, we followed the rules. As any good teacher would say, you have to explicitly show your work, because there are sometimes multiple acceptable ways to do things, like valuing inventory using first in, first out versus a weighted average. The standards demand that companies disclose exactly which acceptable policy they chose. Transparency is literally everything here.
And this brings us to the true power of standardization, comparability. Once the rules are standardized and disclosed, we unlock 2 incredibly powerful analytical tools. First, intra-enterprise comparability. This lets us accurately track a single company's financial health over multiple years. Are they growing, stalling? Then we have inter-enterprise comparability, which allows us to measure different companies against one another during the exact same period. You can't compare a scrappy tech startup to a manufacturing giant if they're keeping score with completely different rulebooks, right? Standards level the playing field. All right, Section 2, crushing creative accounting.
So now that we know the rules and why they exist, what happens when companies get, well, a little too imaginative with their numbers? Put your financial detective hats on for a second. How do we stop companies from twisting accounting policies to produce artificially favorable financial statements? Creative accounting might sound artistic, but in the financial world, it is a massive red flag. It's the practice of manipulating loopholes to overstate profits, hide debts, or misclassify expenses just to trick investors. The answer to stopping these financial tricks is strict, unyielding guidance. By creating firm, unambiguous rules around those tricky borderline areas, like, say, whether an expense should be capitalized as an asset or just immediately written off against current revenue, standards effectively crush financial manipulation. You take away the gray area and you take away the opportunity for creative accounting. It's that simple. Which brings us to Section 3, the standard setting factory. So who exactly writes these ironclad rules in the standard setting factory? Well, in India, this leadership role was taken up by the Institute of Chartered Accountants of India, or ICAI, which constituted the Accounting Standards Board back in 1977. It's super important to understand that this isn't just done by a few folks in a dark room. It is a highly collaborative, independent, and brilliantly transparent process. The board involves representatives from diverse industries, government regulators, and even academicians. This ensures the rules are practical, fair, and rigorously stress-tested against real-world business environments. Let's break down the first half of this 8-step formula right here on the board. First, they identify the specific problem area that actually needs a standard. Then, a dedicated study group is put together to write a preliminary draft. Step 3, this draft doesn't stay a secret. It's circulated to specified outside bodies like the Securities and Exchange Board or the Ministry of Corporate Affairs. And Step 4 is where the board actually meets with these representatives to ascertain their views and gather initial feedback. Continuing the process, the revised draft is then issued to the public as an exposure draft. Step 6 involves painstakingly considering all the public comments that roll in. Then, in Step 7, the ICAI Council reviews the final draft and modifies it if absolutely necessary. And finally, Step 8, the accounting standard is officially issued for non-corporate entities by the ICAI or by the Ministry of Corporate Affairs for corporate entities. It's an exhausting, thorough gauntlet, but it absolutely guarantees quality.
And finally, Section 4, the current standards landscape. For our final lesson today, let's examine where our rulebook stands right now. Notice how the financial world is a living, breathing system. Historically, the ICAI has issued 29 accounting standards, but as business realities evolve, the machinery has to evolve too. For instance, AS6, which dealt with depreciation, was actually withdrawn and merged into AS10 regarding property, plant, and equipment. Similarly, AS8, covering research and development, was withdrawn and replaced by AS26 for intangible assets. The rules are continuously refined to keep up with modern realities. So, if there is one key takeaway you need for your final exam today, it's this exact number, 27. Accounting for the ones that have been merged or replaced, there are effectively 27 active accounting standards governing business entities in India today. These 27 rules are the ultimate guardrails, ensuring honesty, transparency, and comparability in the financial markets. Class, I'm going to leave you with this take-home assignment to ponder. As borders blur and global business environments continue to merge at lightning speed, are we heading towards a truly universal language? Will international frameworks, like IFRS, eventually cause local standard boards to simply converge and fade away entirely? It represents the thrilling, rapidly changing frontier of global finance. Thank you so much for joining today's explainer, and remember, keep questioning the numbers.